Hi, welcome to the inaugural Macro and Markets on Your Finance TV. And what a way to start this series. We're joined by Nicholas Bohnsack, CEO at Strategas Asset Management. Nick, welcome. It's so nice to have you on the show.
You're very good to have me. Thanks.
Absolutely. And for our viewers, Strategas Asset Management have two actively managed ETFs, SAMT, the Strategas Macro Thematic Opportunities ETF, and SAGP, the Strategas Global Policy Opportunities ETF. So it's fair to say macro and policy is certainly in your wheelhouse, and we'd love to get your view on some of these topics.
Well, looking forward to it. Let's jump right in.
Absolutely. We saw, the Fed raise rates 25 basis points at the May 3rd meeting. This was widely expected, and they removed the language around additional policy firming may be appropriate, which initially gave a little relief to the market. But then the press conference started and things turned around. Do you think these hikes are sufficient in curbing inflation? And if we see more turmoil in the banks, specifically more being shuttered, would you expect the Fed to have to examine potentially cutting rates sooner than anticipated?
Yeah, well, if you're right to sort of zero in on that as sort of what's moving the markets this week. I think this was probably Chair Powell's least impressive performance up on the rostrum after a meeting. As the time went through the hour, I think the message got increasingly muddled. I think where we come down on it is really two points. It is the Fed's desire, Maddie, to try and arrest inflation back to an acceptable level. And they've brought the Fed funds rate up and through the level of inflation, and the year-over-year rates of change of most prevailing price metrics are moving lower. So in part, they've accomplished part of the mission. The question, and I think the concern from the Fed's vantage point, is if they pause or if they're in a position where they have to ease, and we can come to that, does inflation turn right around and go back up? And I know that I believe that I know that the Fed looks at the 1970s as being a policy error in their adjudication of fighting inflation, meaning they thought they got there, they sort of took their foot off the accelerator or off the brake, so to speak, and inflation sort of roared back to a series of successive highs. The sort of brewing regional bank crisis, though, may test the Fed's mettle, and increasingly people are calling an end to what has transpired and say, well, that's it. We think we've got everything nipped in the bud, and it's our concern that we've only just started to get into the weeds on whether it be a commercial real estate crisis that is a mismatch of assets and liabilities that's sort of causing an issue for the regionals, or it's sort of a debt-related issue and credit specifically that is beyond real estate. And on average, we've seen over time that when the Fed stops its tightening program, it's about 100 to 115 days before they put themselves in an easing position. And I think this Fed and in this inflation environment would really prefer a longer range of visibility before they have to turn and move the other direction.
It's certainly the Fed seems to be in between a rock and a hard place at this point, so we'll see how it all pans out. Bringing things to the consumer, I saw a headline on Bloomberg that most Americans would struggle to cover an unexpected $400 expense with cash, which is quite the headline in itself. We've seen credit card utilization increase to new highs over the last couple of years, yet the pundits keep saying that the consumer is strong. Surely in a rising rate environment, increasing unemployment, and this crazy credit card debt, things have potentially got room to unravel.
Yeah, I don't know that we would characterize the state of the consumer as being strong. I think your point is very well taken on an increased use in revolving credit facilities, whether they be home equity lines of credit or more traditionally sort of credit cards. And we've seen data on credit card issuance increase. And at the same time, we've seen credit quality deteriorate in terms of the utility of those loans. One of the interesting offsets is that we haven't seen nearly the spike in unemployment or labor market weakness generally that we would associate with sort of this pre-recession progression or a weakening of sort of the economic background that we've seen historically, number one. And number two, the pretty dramatic increase in interest rates, which we just sort of spoke to a minute ago, and really the impact that that's had on money market funds, is actually delivering $20 billion of income every month to folks that are in those facilities. So there is a little bit of a backstop, some of it for the consumer, some of it for corporate operators that are leveraging those facilities, where there is an increased and sort of new income source, and it may be helping to buoy the consumer in here.
Well, thank you for that. And now kind of like moving on to something slightly different. Commercial real estate's definitely been a focal point recently and a source of rising concern. Most recently, BlackRock's head of alternatives said private equity exits are getting harder. Are we teetering on the edge of something quite catastrophic here?
Yeah, I'm always sort of hesitant to use the anything associated with catastrophe, but I think you're getting to a point where that starts to become an interesting adjective to describe the circumstances. For us, the commercial real estate bottom line is the impact that will have on state pensions, right? And so, you think about who had to reach for yield in the last 10 years, and debt liability managers are sort of in the center square, and state pensions sort of fit the bill. So as we've seen occupancy rates decline, and we see renewal rates in terms of commercial real estate start to weaken, all of a sudden these banks, many of them regional, are sort of holding the bag with a debt portfolio, whether it be directly on the balance sheet, and in some instances by extension through a fund or a real estate trust. And those have generally been posted as collateral for other reaches into the yield spectrum. So all of this is sort of a confluence around a general weakening of the economic environment and this sort of universal acknowledgement that the way we go to work may be different in the future than it has been in the past. And sort of commercial real estate really takes it on the chin in that regard. So to say that Silicon Valley Bank or Signature or First Republic or even Pacific Western, as we've seen, in the last week or so, is sort of the bottom line on this. We think we're really only just scratching the surface, and we haven't quite seen where the most acute degrees of pain will be felt. I think commercial real estate has its comeuppance ahead of us.
And it's quite scary. You highlight some of that domino effect that will come from that.
Right.
So we're going to keep an eye on all of this. Nick, I'd be remiss in not bringing up the debt ceiling. Do you see a resolution to this before the June 1st run out of money date?
Yeah.
Or it being drawn out and becoming a messy conclusion? And it's kind of a double question here. And what are the broader implications to extend through the deadline?
Yeah, well, I mean, listen, who doesn't have faith in government? And all the sort of really well-respected independent studies suggest that unfortunately not many people do. And so we'll have a rhetoric sort of driven cat fight between Republicans and Democrats. You mentioned June. I think the X date is moving. In terms of when special accommodations will have to be made by the Treasury. The Treasury General count has just been refilled because of tax payments in April, and ostensibly you'll get another round of some of the quarterly estimated payments that would typically come in June, and so Secretary Yellen will have some resources at her disposal to make some of these special accommodations. But I think the real issue is, whether you're a Republican or a Democrat, I'm not trying to offend anybody's political sensibilities, is that Speaker McCarthy was able to move a bill through the House where I think a lot of political observers wouldn't have guessed he was able to do that. That in a way puts the president on the back foot by continuing to not be willing to come to the table to negotiate. He said, I have a position and you're going to have to, address the debt ceiling in that way. And I think the president's going to find himself negotiating at the end of the day. So that's part one, and it'll be messy. And it may even sort of, thread through the deadline. And then so you risk a government shutdown. That's one knock-on effect. You risk special accommodations by the Treasury. That's a second knock-on effect. And moreover, what we're seeing in the bills market is that there's a lot of concern on investors' behalf in some of the short-dated Treasury paper, 2 months out probably to about 6 months. And the real investment implication of this, Mehdi, and it goes back to some of the institutional investors we were talking about with respect to your commercial real estate question, is different types of enterprises as asset managers can only post certain types of collateral. And the 1 year to 2 year bills market, notes market is sort of a no man's land, right? Not enough duration for sort of equity alternative, right? Not enough yield for credit, not enough yield for credit investors. And so all of a sudden, as we approach this X date, things start to get really sloppy in the credit markets. And of course, credit market volatility doesn't generally portend well for equity markets. And then you have, at the same time as the debt ceiling is coming to fruition, you have a Fed that is dealing with a regional bank crisis, and you have an earnings paradigm that is weakening. So to sort of put a bow on all of this, I think for our viewers, for your viewers, is on the one hand, you've got earnings and interest rates. And those are the underpinnings of risk asset prices. And on the other hand, you have labor and liquidity. And right now, these two sort of categories are sort of fighting it out in the middle. And I'm not sure we get any place in terms of resolution without more volatility, unfortunately, in the weeks and months ahead.
Nick, I really appreciate you sharing your time and your thoughts with us. It's been very interesting and eye-opening, and a little bit scary, to be honest, as well.
Unfortunately so. Next time, only good news, I promise.
Only good news. Nick, thanks again. And to our viewers, thank you for watching. And until next time, good luck investing.